to $95 billion. Worth pointing out, that is twice the pace, double the pace basically, once they get to $95 billion than the pace we were running at last time around when balance sheet runoff started. When was that, Bramo? 2017, 2019?
Something
it's
like
quicker,
much
quicker.
Faster. But they've got a lot further to go. And a lot of people take a look at the labor market, they see a lot more momentum. I do want to go back, though, to this idea, this dueling objective, where they're talking about getting inflation down. What is the time frame, as Mike was saying, to get back to 2%? Is it okay if it happens in 2035?
Well, I think ultimately right now they don't have to choose between growth and inflation. They can focus on inflation because the data is good. We heard that in the last news conference. I would have expected to hear that again in this news conference too. But this line in the statement I think is pretty interesting. The committee is highly attentive to inflation risks. Then he talks about China. I say he, not just the chairman, but the whole of the Federal Reserve. The issues there are likely to exacerbate supply chain disruptions. Then on top of what's happening in Russia and Ukraine, that's likely to create additional upward pressure on inflation, okay, but also likely to weigh on economic activity. Now, this is the dilemma that people think the Fed might face towards year-end, Tom, where they have to choose between supporting growth or curtailing inflation. And that's the dilemma that maybe a lot of people obviously don't want this Fed to have to face.
I'm not going to overthink that, John. I'm going to look at the partition here. You know, given the supply shock you talk about and the continued shocks, the China lockdown, of the separation of domestic and foreign economics for America. Someone to partition that for us and to expect the unexpected is Scott Minerd, Guggenheim Global CIO. Always controversial, always interesting, ready to take notes. Dodgers strong this morning. For those of you on radio, Mr. Minerd, very much LA Dodgers right now. Scott Minerd, I'm going to cut to the chase. We have to expect the unexpected, and that always speaks through the bond fixed income system. What will the price of bills, notes, and bonds do?
Well, I think right now, Tom, we're actually coming to a near peak. When you see how much we've backed up, we're from where our models sit, we are now 5 standard deviations away from our predicted level for rates. That tells you that we're like 1 in 3.5 million probability of getting to this level. We're really overextended, and I think that the Fed, with its inflation fighting, statements here, that
it's better. Okay.
It's very,
you guys are a little delayed on the sound part here. I'm going to keep all the changing the way I do it, so you're hearing the sound from my computer and from my microphone.
That
should make it a little bit clearer.
The market
is Jerome Powell went for the
0.5. The real question in my mind is
50
going back to the 1930s.
The market was kind of pricing in the
0.75 by more than 2.5 percentage points.
I was expecting 0.75. I was actually hoping for it.
So
I don't think 0.5 is aggressive enough to whip inflation.
If we don't get close to the 2% target, it's very likely
he doesn't
that
want to
we will
overextend,
have some kind of an economic slowdown well before we get to the desired inflation target.
When we see the trade balance today, that's the kind of shock that's almost exogenous to the zeitgeist out there. What items are you looking for, Scott, that feed into you this recession call? What are the things that matter to get to a true contraction?
Well, not just the loose policy
Tom,
on the Federal Reserve.
Everything we talk about, and you'll appreciate
but I don't know if 0.75 is going to be quite enough.
We keep talking about the rate of change. And the rate of change is obviously the first derivative.
All right, and how's that looking for you guys?
I don't hear people talking about the second
I'm using
derivative.
A new way of inputting sound here. It's supposed to be better.
What is the deceleration that's occurring in various parts of the economy? If we look at money supply right now, on a year-over-year basis, we have M2 up,
turn down the boys a little bit,
above the inflation rate by about 5%.
All right, I'll wait for you guys to let me know if that made any difference.
But when you look at it over the last 3 months, we actually are having real money contract by a rate of 3%. The second derivative is the thing that's going to tell us how quickly that we're going to get there, and I think the market is not focused on that, but I believe that somewhere here in the near term, we're going to get preoccupied with how quickly all these numbers are changing.
Well, Scott, let's talk about what it means for this market. You've seen the story in the Financial Times. The bond bull market has come to an end.
Sounds like the sound is a little bit better.
Scott Minerd says. I know your view is so much more nuanced than that. From a tactical perspective and from a longer time frame.
It sounds like we're talking about the end of the bull market. Jonathan Farrell, I listened to him on the radio. And see what he has to say.
Sure. Well, as Jonathan, as I mentioned, using a cyclical adjustment for bond yields, we are now, well away from any outcome we would expect if the long-term bull market were still intact. But having said that, right, even when these long trends end, this 40-year bull market ends. We saw this when rates rose in the 60s and 70s. What happens is we tend to find we break the trend, but we then do a mean reversion and we go back down in yields. So I'm expecting that rates here are not going to go skyrocketing off into the stratosphere, but what we've done is by breaking the long-term trend, we now are probably in a protracted period, maybe 5 to 10 years, where the range on interest rates is going to be somewhere between the lows that we've had already and the highs that we're currently seeing, and that at some point, like in the 1940s and the 50s, that we will break out of that consolidation range and we will begin a generational bear market in bonds. One interesting thing to remember from the 1940s, we didn't break 2.25% on the 10-year note, which had been the high for the previous decade, until 1952. Once we started with an increase in interest rates, it took us 10 years to get to 3.25. So, when I say the long-term bull market is over, and I think it's very clear statistically when you're talking about probabilities of over 1 in a million that you're still in a trend, that doesn't mean that we're instantly reversing course and going to go rocketing higher. What it's telling us is we're probably going to go into a long period of consolidation and ultimately find ourselves somewhere in the next 5 to 10 years in a sustained bear market in bonds.
Look at this spike on the NASDAQ, how as soon as the report came out, about half a basis point, it shot up and then came right back down to almost flat.
If you took that FT headline,
and that got sold off right away.
Saying dump bonds. You're not saying that. So can you tell us more specifically what role bonds have
Stonked
in the portfolio,
thank you for the super chat.
Given what we've just heard from the Fed and what we're expecting from the Fed further down the road?
Right. Well, Jonathan, I think
I am a big fan of Lisa Su too after all this.
Inflation fighting is number one priority. That gives me a lot of confidence that given how extremely oversold we are, that we're going to see a near-term rally in bonds. Somewhere, it's not necessarily starting today. It's not starting next week or next month, but it's not far out. And so I would expect that we're going to see a reversion back to the mean, that bonds will ultimately perform better again. And honestly, for people who are income-oriented, where today you can buy corporate bonds that are yielding 4 to 5% for high-quality corporate bonds,
that's a good
those are attractive
4 to 5%.
income yields relative to where we've been. And there's a lot of money out there that would like to get higher income, whether it's in pension funds or insurance companies or just
what's great right now is
IRAs.
Series 1 bonds or Series I bonds.
Near term, I'm actually
9%
fairly
is the current
bullish.
rate on those.
I think rates will come back down. We shouldn't be panicked. The Fed has been very clear. We're going to fight inflation. We're not worrying about the economy right now. So inflation fighting is priority number one, and that's the sort of environment
can't thank you enough for the double
perform
super chat.
well.
Scott, you've been in the Milken Conference
Good luck
for a
at work,
while.
brother.
Do you think that people generally are too bearish or too bullish in terms of their
Half a basis
investment
point quick
theses,
pineapple.
let alone just what they're
50
saying, their
basis points.
prognostications about the longer or even medium-term outlook?
Well, it's really interesting, Lisa. Everybody seems to be so uncertain about the near-term future. But
look at the 2-year, how
the
quickly it just dumped.
longer-term view seems to be somewhat positive, if not bullish. I had a breakfast this morning with a major investor in private equity, and he was telling me he thinks, we're going to have a tough go for the next 8 months or so in stocks, but ultimately we're going to come out of this and do well. I'm always skeptical of the consensus views. The view today is so bearish on stocks, so bearish on bonds.
Right.
every time we get this far out of consensus, it seems that the opposite direction is the way to go.
Volatility ought to drop very, very quickly after this.
John Farrell, Lisa Brownwitz, and myself, we welcome all of you to truly an historic day, to a 50 basis point move in the rate as
expected.
Volatility
just
and
dumped
John,
right
if
here.
I look at the entire Bloomberg
Down
data
4.5%
screen,
already.
I guess I've got to just simply say equity's up. They like what they see.
Yeah, and then the news conference in about 15 minutes. And I can tell you, Tom, a big question on the south side that many people have been looking for is the 75 basis point question from the Federal Reserve. A lot of people out there want to know. You're going to hear that in the news conference by at least one journalist. His thoughts on that, and within that answer,
I always listen to these Bloomberg guys on the radio.
Yeah,
this is not what I thought any of them looked like.
On 75 beeps, but he may talk about the
I didn't think this guy looked like the penguin here.
End of the year. Diane Swonk is focused on the end of the year with Grant Thornton, their chief economist, and we're thrilled she could join us today. Diane Swonk, I want you to look out, as Michael Feroli of J.P. Morgan did a moment ago, at the two-part
this is the website
economy
that Tyler
that Chairman
Diamond is
Powell
referring
faces.
to.
A buoyant, fully employed domestic economy, maybe with a negative statistic, off of the international dynamics, export, import, inventory, build. Does he have to coalesce those two together, or does he ignore the trade balance and say, I'm focused on a good American economy?
I think he's going to ignore the trade balance. I think the biggest issue here is he's focused on inflation, and he's going to be more Volcker-esque in terms of inflation. This is a Fed that, many of the leadership have now said, a little hard to get to that soft, magical soft landing, and you're hearing more within the Fed.
None of those guys look like I thought they were going to.
Is a word that Chairman Powell himself used, softish on the landing.
Softish.
That's harder, and our own analysis, softish. He actually used that word, soft or soft-ish.
Sorry, I had to
and I
screen
think
cap
that's
something
really
real quick.
important because our analysis suggests we need to get above 5% on the unemployment rate to derail the inflation that we've got out there right now. We've got 1.9 job openings per worker. That is up from a little above 1-to-1 back in February 2020, which is what Powell wants to get back to. You've got to both hammer demand and increase supply of workers. The only way to do both is to raise
Diane, I don't mean to interrupt, but this is too important before this press conference. What is the carnage in economic growth to get us out to a 5% unemployment rate?
5% would be pretty high.
It depends on how fast you want to get there. You can get there with a soft landing, with the economy stalling out on the domestic side in the second half of the year and into 2023. That's by the end of 2023, where growth is just not enough to hold on unemployment. Or you can get there more rapidly by actually having a contraction in growth. And that's where the uncertainties with the war in Ukraine, all of the other issues, the supply chain issues we face, really hard. The Fed's decision today is that they've got to bring demand down to a supply-constrained global economy. And the only place they can increase supply actually is in the labor market. And I think that's a really important issue that gets lost in translation. It's that this is a Fed hammering demand, and we can do it with a soft growth recession, a mild recession that's more prolonged, or more aggressively, but it's the
so if I'm gathering this right, is she saying that if we can get more people to go back to work, inflation will be reduced?
One of the things we do know is that mortgage rates that go up don't necessarily hammer the housing market and home values. Mortgage rates that go up rapidly, like we've seen, are nonlinear and have a much more dramatic effect on both of those things.
Diane, another way of illustrating the tough job the Fed has is just going through their forecast. The last time we were all together, we had the summary of economic projections from the March meeting. The forecast looked like this. PCE 4.1% for 22, 23 it comes down to 2.6, 24 down to 2.3. And the curious part of the forecast was the fact the unemployment rate was at 3.5 for this year, 3.5 for next year, and 3.6 for the year after that. Dan, everything you've
looks
said,
like my Strangles video fully rendered.
It is incredibly unlikely that they can get inflation down to 4, down to 2,
I'll publish
keep
that tomorrow
unemployment
morning
exactly where it is
on the Strangle
at
strategy, which is working out great right now, by the way.
Well, I never did, so I still don't. I think I called those forecasts fanciful at best when they first came out, and they just don't count. They just don't add up, and that's the reality we face. And you're now starting to hear that from within the ranks of the Federal Reserve, talking about a harder landing, talking about how hard it is to get to this. Former Fed Vice Chair coming out, Don Cohn, and saying, the probability of them being able to do this all right, 25%. That's a 75% probability that they slip into a recession in his assessment. I think this is really important, is the Fed is now in the position where they're focused on inflation and employment is secondary. That is a very different equation than we've seen the Fed in for a very, very long time.
Does it remain that way? Dan, I think is the more important question, isn't it? Because you can say those things right now as a Fed official because unemployment is at 3.5%. But when it starts to go the other way, when you start to see demand get hit, will you remain committed to inflation if it's still at 4 or 5? I guess the easier way of asking this question, and we've asked it through today, through the morning and into the afternoon, if they have to choose between supporting growth and curtailing inflation, do we know, Dan, what they'll choose?
That's a good question.
They'll choose containing inflation. I have no doubt of that. And that may come because of the nonlinearities that we see, or
now,
maybe come because they...
If somebody has expertise on this, now let me know, because what they're describing here is the Fed going to prioritize cutting down inflation or keeping employment high. What should they do? Well, if they raise the rates, they're going to cut down on inflation, but that's less demand in the labor market now. So what's their goal going to be? Keeping people employed or keeping people from facing high inflation? Now, from my point of view, if we have inflation rising and unemployment also rising, that's like the worst possible scenario. So what they're hoping here is that these rates are going to increase, or rather decrease, the amount of inflation. And if it does not, because unemployment is starting to tick back up again, if we don't have inflation dropping while unemployment rises, and instead they're both rising together, that's a worst case scenario. Now, if they have to choose between them, she's saying that they're going to choose to keep knocking down inflation rather than keep people employed.
Raise rates. Either way, we're getting
inflation rate. They reiterated that in their statement. And Tom Porcelli over at RBC had this to say. He said he wants to understand whether Powell wants to get that 2% inflation target before he stops raising rates, because if he does, then funds will be meaningfully higher than what most folks seem to think at the moment, and recession
Didn't Amazon
will be upon
just
us.
lay off
Do you think,
100,000
Diane,
employees or something?
that Jay Powell wants to see 2% inflation before he stops raising rates?
I do. And I think that's because of the environment we're in. We do have some things that are an offset. A strong dollar is not the situation we had in the 1970s when the dollar was depreciating. But we've got a global inflation environment, and central banks around
Check out this
the world
Twitter
has
thing
been
here
slow
too.
on the uptake because
morale at Twitter is
of
low
the
because they think any
pandemic.
work they do
The
now is going to get
1-2
overridden by
punch
Elon
of the
Musk anyway.
pandemic
So they're
and the
just
war in
not
Ukraine,
doing work right
and
now.
then the Fed citing the lockdowns in China as well. I think they really are focused on how supply constrained this world is, but that they can't look through those supply constraints. They now have to deal with them. And I think that's the reality we're dealing with.
Initially, after this Fed decision came out, the reaction in markets was pretty quiet, things fluctuating around. Now they're decidedly lower on the equity side as people parse through. And I wonder, Diane, how much it has to do with exactly that point. The fact that the risk factor with China lockdowns, the risk factor even with the Ukraine war, was to higher inflation. And that was the emphasis more than slowing growth.
Exactly. And I think the reality is we're talking about also the risk of stagflation abroad, accelerating inflation even as they may contract in response to the war in Ukraine. That is an untenable situation and an unsustainable situation, and one in which the Fed as a central
even though I'm
bank of the
pretty
world
bullish
has to
in my
take into
positions
account as
overall,
well.
since I have all those long-term positions, I'm honestly hoping that we rip this Band-Aid off and things start tanking so that we can get it over with. Because this little tap dance that we're doing, it's not getting the job done. And inflation keeps going higher, despite all efforts. People aren't going to be able to buy houses like they were a year ago because those rates have increased. So now we're going to wind up in a situation where we have to experience this great reset. Prices have to come back down.
How political does Powell have to be sensitive to the Washington process?
Well, I think, Tom...
Yeah, you guys talking about the price of eggs and dairy? I'm seeing the same thing. I started shopping at Aldi because it was getting more expensive to shop at Safeway. So I started going to the discount grocery store. Eggs went from about 93 cents to $2 and change in just overnight. So is it supply chain or is it something else?
Than they normally would be, because they want to demonstrate politically that they're being strong and they're fighting inflation. The thing that I find interesting, and I agree with Diane, I love the way she divides this up into a two-part issue, which is the first part is this inflation battle that we're currently in, and then there's this period that comes later. My biggest concern is that because of the political pressures, if the sentiment in Washington should flip and unemployment becomes a bigger concern than inflation, that the Fed would then find itself feeling that it had to pivot before it reached its 2% inflation target. And if it did that, that deeply concerns me about the credibility of the Fed in terms of being viewed as an inflation fighter, and it would probably bring forward my outlook longer term that we will eventually enter a bear market in bonds, because Diane is right in terms of we have a lot of structural problems here. We don't have enough workers. We have to rejigger supply chains. There are shortages. So structurally, our economy right now is not set up to allow the Fed to pivot early if they don't have inflation under control, if unemployment begins to rise and they start to feel political pressure coming from Congress.
Scott, embedded in that statement that you just made was a question about the credibility of this Federal Reserve. Are you saying that this chairman, Jay Powell, is sensitive to the political mood of Washington, D.C.?
Absolutely. And I'll tell you why, Jonathan.
The bird flu epidemic is making eggs
what
increase.
Tom was alluding to was the pressure that Arthur Burns and people like that who were chair of the Fed
You know how much money it cost us to make a quiche yesterday?
With Lyndon Johnson and Nixon to continue to allow
Power cow, that's
inflationary
bad news,
pressures
man.
to
What does that mean
build
for you?
to
You gonna
keep
be able to
the
proceed?
economy moving. And so I believe that the Fed's independence is being more challenged today than it has been in generations. And the chair knows that, the committee knows that, and they are being more reactive to the political pressure than they might have been under a Volcker or a Greenspan or a Yellen.
You know what's been effective
Diane,
too
does that
to fight
resonate
this
with you at all?
inflation is freeloading. And I'm being serious about that too.
So I would do another
In the last
little
3
nuance
weeks,
on it. I think
$800.
that, first of
Add
all,
that to your
inflation
pile.
affects 100%
Throw it into
of
something that
people,
pays you
and
every
even
month,
though
and,
unemployment
you're not gonna
is
completely buck
absolutely
inflation.
horrific and
But that
extremely
extra income
hard,
is gonna make
it
a
only
difference,
affects
especially
a
for
few
people that are in
percent of
debt.
people. And so inflation is always a bigger political problem than unemployment initially. And I think initially is a very important word here. The Fed's credibility is already on the line because inflation has persisted longer at higher rates than they expected. And transitory in economics, maybe a few years, that's not transitory in anyone's wallets. So I think the Fed
Hey, Adam, thank you
does
so
have
much
their
for the super
credibility
chat.
at stake.
Appreciate it.
I think Scott's right. Their independence is being
You're king.
challenged. But I also think the political landscape is part of what the reality of what we always see with inflation, and that is 100% of Americans see inflation. Not 100% of Americans feel unemployment. Even if unemployment rises to 5%, you still get 95% employed. That's not good. But it's the reality of the politics of this. And I don't think the
Diane
Fed
Swonk's bringing up a good
stops
point here.
when unemployment rises. And
Every
on
single
that
one
side
of us is feeling the
that is
inflation.
also the credibility of the Fed, and they have to go there to reestablish their credibility after falling behind the curve on inflation today.
Diane Swank of Grant Thornton, thank you, alongside Scott Minerd of Guggenheim, on a day where the Federal Reserve hikes interest rates 50 basis points, the biggest move going all the way back to the year 2000. QT, balance sheet reduction, that's set to start in the next month. TK, some big moves still ahead
It is
for this Federal
Throwback
Reserve.
Wednesday. This is the first time in 22 years they've raised rates this much in one
This is going to
shot.
be a delicate press conference. He's going to be tested here with some really tough questions, John.
This guy looks
I
like the
look at
Penguin. I
screen,
can't get over it.
Markets maybe haven't moved all that much, but I would settle in for a press conference where there can be any kind of statement and then that follow-up question, John, which maybe would really set to the next meeting.
Have to.
Oh, here we go. Well, good news. I ran out of time on Bloomberg just in time for Jay Powell to start talking. So he's got about 1 minute, and he'll be getting started here. Talk about lucky timing. I don't think he's going to have anything too critical that's going to really push anything, but depending on what he has to say about what their plans are for the future and what his priorities are going forward, that could make a difference. We're watching these people on Bloomberg all speculate. What's the Fed's priority going to be over the next 6 months? Because we really need to see inflation start taking down, but we don't want to see other factors make for even worse conditions than that, like unemployment ticking up. Because if we have unemployment ticking up and inflation ticking up at the same time, that's the worst possible outcome. That's stagflation, and that's going to send equities down until it resolves. That could take a long time. All right, here's Jay Powell. Why do I have zero sound?
It's nice to see everyone in person.
We're back.
First time in a couple of years.
He's kind of quiet, though. I'm going to turn him up. Let me know if you guys can hear him. He's pretty silent.
Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people.
Uh-oh.
Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down.
Mm-hmm.
We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high.
Mm-hmm.
Against this backdrop, today the FOMC raised its policy interest rate by 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years.
Still not high enough.
Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy.
You know, Jay Powell here, I feel like he's trying to put a
we are on a
positive
path
spin
to
on
move
some
our
bad
policy
news.
rate
But at least
expeditiously
he's
to
keeping
more
it real
normal
and
levels,
saying we need to lower inflation.
assuming that
levels. That's our
economic
policy.
and financial conditions evolve in line with expectations. There is a broad sense on the
I don't
committee
think he
that
should be
additional
blaming Russia
50
for
basis
it.
point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal.
That's the right answer.
With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion
I have
per
no
month.
fucking idea what he's trying to describe right now.
The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency
If anyone
mortgage-backed
understands what
securities, the
he's
cap
saying,
will be
please type it in chat.
$17.5 billion per
He's
month
losing me.
for 3 months
Just
and will
part I
then
don't
increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.
He says he's surprised by the
We
inflation
therefore
rate.
will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay.
Nick Chamarosa, The Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right. 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional
better return on
participation.
investment
So
than
people
a
will be
traditional
coming back
college
into the labor
education.
force. We've seen
Just
that,
make sure you're not
particularly among
majoring in a
prime-age
hobby.
people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation.
How much does J.
Implications
Powell
for
get paid?
inflation,
Does
really
anyone know?
the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation.
Mm-hmm.
That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which
Coughlin.
we would be able to have demand moderate in the labor market.
I make as much as J. Powell.
And therefore have vacancies come down without unemployment going up. Because
Salary-wise.
vacancies are at such an
probably
extraordinarily
makes a shit
high
ton
level.
of
There
money
are
on the side.
1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the Beveridge curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is,
I don't think
as I
J. Powell
mentioned, very,
realizes
very
how much
strong.
more expensive housing just got.
And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Thank you, Ialtha Dos. Uh-oh, I'm out of money in the gun.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible?
Good question.
And perhaps you could walk us through your calibration. Why 1 month or one meeting should we expect at 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering.
I'll be right back, guys.
What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the
My wife
public
is going to the grocery
about what our
store, so that's $100
expectations
out the
will be
window.
as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation, flattening out and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that core PCE inflation is perhaps, either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance.
Right now.
There's just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate, or
I don't think a 1 month is not no 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is
what are you working on right now
in a
for the
direction
challenge?
that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But
Jorge Delgado's got the right answer.
Again, it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation is, if we see what we expect to see, then we would have 50 basis point increases on the table at the next 2 meetings.
Let's go to Colby.
Thank you. Colby Smith from the Financial Times. Given the expectation that
I can talk louder.
will remain well
Is that better?
above the Fed's target at year-end,
I was trying to talk quietly.
what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You're going to raise rates, and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
So we don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply. Longer-term inflation expectations have been reasonably stable, but have moved up but only to levels where they were in 2014 by some measures. So you can look at that, and I think that's a fair description of the picture. But it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point, was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if if we don't see that financial conditions have tightened adequately or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen. So we'll look at it that way.
TQQQ 0 data expiration calls or something like that, and make tons of money in the last 20 minutes.
Great. Thanks, Chair Powell. Gina Smilik with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market where demand is substantially in excess of supply of workers. And you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chains healing, and so or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way they're two further negative shocks that have hit really in the last 60 days, 90 days.
Victoria.
Anyone got that girl's OnlyFans?
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2-to-1 job vacancies to unemployed people. There's a lot of excess demand there. More than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation. If you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored, and that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
Howard Schneider with Reuters, and thanks, and nice to be back. So two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really you've got to get to a place where the labor market appears to be more in balance. And that depends not only on the level of those things, it depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1-to-1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending, and then you can think of another big one as asset values broadly. And there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Just look at the way the market's reacted since this meeting started. This is the opposite of the last one. I'm missing out big time.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, a 50 basis point rate hikes or multiple hikes? How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So, the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same
You
thing.
heard him, guys. He said
If
credit spreads are the way to go right now.
Economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy, and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates. So higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately,
nice raindrop just this once.
We think
I'll
about
do
the
it.
medium and longer term, and everyone will be better off if we can get this job done. The sooner, the better.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. If you look at the labor market, for people who are out of work and looking, there are lots of job opportunities. For wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents, who both said that that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward.
Guys,
but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances. It is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
I do admit, though, that Jay Powell is doing a much better job this time versus last time.
Thanks, Steve.
He's able to calm the market this time versus
you mentioned
scare it last
earlier,
time.
just now, fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given. We don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there, and we look at it as our job to given all the factors that are happening, to try to sustain maximum employment and price stability. So, if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that. Stick in our lane.
Steve Matthews.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you
Nick
agree
Richards,
with that?
I almost missed you. Thank you for the super chat.
You recently spoke in great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. So we're absolutely prepared to do that. Wouldn't hesitate if that's what is taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. And I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't a particular thing. It was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test. It isn't will we do one particular thing. I would say We do see, though, we see restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody, really. And so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest expansion cycle in our recorded history. And in the last 2-3 years, you had the benefits of this tight labor market going to people in the lower quartiles, and it was, racial wealth and income, not wealth, but income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place, but to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. We have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side, and we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have numerous supply shocks which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Thank you. Chris Rugaber and Associated Press. Earlier, you just said that if necessary, I think were the words, that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. The point is we're a very long way from
covered calls on
TQQQ
are getting destroyed.
We're moving there expeditiously, and we'll continue to do so. And
I'm up 10 grand.
We can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And, I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again,
I'm down $2,200 on my TQQQ covered calls.
To go to those levels, we won't
guys.
hesitate.
Mike McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility with the American people?
So why June 1? It was just pick a date, and that happened to be the date that we picked. It was nothing magic about it. It's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I would just stress how uncertain the effect is of shrinking the balance sheet. We run these models, and everyone does in this field, and make estimates of what will be the how do you measure, a certain quantum of balance sheet shrinkage compared to quantitative easing. And, these are very uncertain. I really can't be any clearer. There won't be any clearer. People estimate that broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that that it is part of returning to more normal and more neutral financial conditions. And our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes I want to remind us really that that's who we work for, and that it's inflation that people are feeling all over the country, and it's very important that they know that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that, and so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that, so in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting, very appropriately, not to bless any particular day's measure, but the way financial markets, the forward rate curve has tightened in response to our guidance and our actions really amplifies our policy. I mean, it's monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points, and that's all through the economy. People are feeling those higher rates already, and so that shows that the markets think that our forward guidance is credible, and I think that's we want to keep it that way.
Scott Horsley, did you have your hand up? Okay. Brian, Chung.
Hi there, Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle? Thanks.
Well, so as I mentioned, you can see places where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up and at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is that as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works.
If you care to enjoy.
Ultimately, getting supply and demand back, back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation. I mean, so yes, there may be some pain associated with getting back to that, but the big pain is in not dealing over time, is in not dealing with inflation and allowing it to become entrenched.
Greg, Rob.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could take a step back and talk about, in March, the dot plot had, looked like steady quarter-point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So, look, I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually come, month by month inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got 3 or 4 really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year. But that hadn't happened yet.
What do you think, guys?
Anyway,
was
we
this
got
the bottom?
an ECI reading
Did we-
employment compensation index reading the Friday
did we
before
just
the
get
November
saved by
meeting.
Jerome
Then we got a
Powell?
really strong jobs report. Then we got
Because
a
according
really
to my
high CPI
T-triple-Q
report.
covered calls-
And so I think it became clear to the committee that
I sold the bottom.
we needed to adjust and adapt. And we have. Ever since then, really ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see, unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right. And by the way, other forecasters have been doing the same thing. And it's just us adapting to the data and to the situation and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices and maximum employment, especially when the unemployment rate for black workers is still roughly double, roughly twice the rate for white workers.
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So
Easy E, thank you for the contribution. I appreciate
so
it.
that's one thing I would say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't, because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are to some extent being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower income part of the distribution, especially them. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by inflation, and where we can have a long expansion too. That's the good thing, is you can have, as we've had several of the longest expansions in U.S. history have been in the last 40 years, and that's because it's been a time of low inflation. And long expansions are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term, and I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
I guess that's a wrap. Well, the market obviously absolutely loved what he had to say, and I agree with the people in here saying that the reason everything shot up is because he said that a 75 basis point hike is not on the table. Now, the question is, right now, that might be the case, but how long is that going to be the case? If inflation keeps shooting up, is Jay Powell going to change his mind suddenly about a 75 basis point hike being on the table? I think the fact that he took it off completely for now has the market excited. Maybe we can achieve that soft landing. But it is amazing to see how very quickly the sentiment in the market changed. Not just in equities prices, but across all the social media boards, messaging apps, Wall Street bets. Everybody is all of a sudden extremely happy. Versus 3 hours ago, everybody was absolutely pissed. Everybody was calling for the worst recession we've ever had. No, that's the wrong one. Everybody was calling for the worst recession we've ever had in years. Now all of a sudden everybody is extremely excited about it. So Yellow Gary says that this happened last talk too. Now, if I'm not mistaken, last talk it shot up when the press conference immediately started, and then about 2 minutes into it, everything just dropped. That's my recollection of the last meeting. Am I thinking of one prior to that still? Maybe. Yeah, what I'm sharing right now here, this is my brother's first YouTube video. So if you want to watch me and a couple other people smash a chair with wooden hammers, check out that YouTube video that I just pinned. Let's go back over to Bloomberg and see what they have to say. Oh, wait a minute. I ran out of Bloomberg. I guess I gotta sign in. All right, stand by, guys. All right, we're back.
A conventional theory in 2022.
Oh, this is old information here. Let me try that again. Otherwise, we can go hang out over on Wall Street Bets and see what, why don't we do that? That sounds like a little bit more fun. Let's go to Wall Street Bets. And let's see what everybody has to say. Yeah, Robert Gresham. I think that I recall that happening too. Like as soon as he came onto the stage, it shot up, and then immediately when he was talking, all of a sudden everything started tanking. All right, let's check out the daily discussion on Wall Street Bets. Well, we have everybody's attention. All right, Swing Masters agrees this is a dead cat bounce. And everybody's a little bit excited about J-Pow. So my position right now was a 421 by 423 call credit spread on SPY. That was my big trade. Now, this morning, that looked like a great trade. Now, it's eating me alive. Yeah, ugh. It's a pretty ridiculous day here. And my TQQQ covered calls at the $36 strike. Yeah, that's struggling. Hey, thank you, Sticks, for getting on board with that, too. Yeah. All right, in the Wall Street Bets environment, somebody sold a SPY put at a profit for $3. It's worth nothing now. Rest in peace. That's just gambling, but we remember what sub we're on here. Lost so much on puts today trying to protect his calls. Mary J. Wana says, making $2,000 in 30 minutes is better than sex or any drug I've ever done. I can actually get on board with that. I can agree. Given the choice, the opportunity cost of giving up that $2,000 is extremely high. So I would take that. Big Tech equals value. Bought a 420 call on Triple Q for $1.30. Sold it for $6.15. There's got to be somebody in here who like 20,000 made 20 G's or something like that in 15 minutes. Just, during that speech, watching the way the stocks went up. So I'm restarting the 3K challenge because I think a lot of people like that, and it was kind of the most enjoyable one that I did. But I haven't traded in the account in so long. I came back to it and started again. This is what I have. So for between here and not even that, between like October and now, I don't think I've barely traded in this account. But the big trade right now is the SPY 421 by 423. And over the past week, it was down at 59 cents. I was up 50%. Now all of a sudden, I'm down $17 on it. Not a huge miss, not a huge hit. But to see it have gone from a profitable trade to an unprofitable trade within a span of minutes is scary. I just missed it when it was down here. I typically like to close these spreads at 50%. I think it was about like 48, or what is it? 49.5% is how much this thing was down. So I was up almost my target, within 1 point of my target. But of course, my limit order doesn't fill, and now we go in the complete opposite direction, which is pretty painful right now. But at least AMD is up nicely. I'm going to be honest, part of me just wants to liquidate a whole bunch of positions in this portfolio so I can actually have some money to go with when I start doing the challenge again for real. I mean, do I really need 30 shares of iPod or 19 shares of YOLO, which is like the worst, probably one of the worst investments I've ever made? what did I buy it at? 15.94. So I bought it like here and felt smart. Somewhere in here, like middle to the end of November of 2020, and felt smart. And now I'm going to go down. Yeah, I think Calef is right. Now is the time for call credit spreads. I did it at the wrong time. That was my only mistake, of course. Triple Q shooting right back up. AT&T did a spin-off. Anybody who had like a large position in AT&T should be getting a share of Discovery Network soon. Hey, is anybody long on Lyft? I mean, I'm looking at just, I only have the one share that I had from, I don't even know when I bought this thing, a long time ago. It's getting wrecked. Let me say, Easy E, thank you once again for another super chat. Thank you for the Iron Condor. For the super chat. All right, your Iron Condor is 406 by 428 on SPY, sweating bullets. Yeah, you're a little close there. When's your expiration date on it? Because SPY is, you're at max profit position right now. We're getting close. But you're still in the maximum profit position. 406 by 428, that's a pretty good range, I think. I can't tell you what's going to happen, but there is some reason to believe that we're going to have, a bull trap that lasts longer than a day or two. I could see it going up for a couple of days here. But until we get some evidence that inflation is actually ticking down, I don't think we're really out of the woods. I think we need to have some real tangible results from what Jay Powell is doing before we can say, this is it, we've hit the bottom, we can start going back to real life again. Lyft, the reason I even have this position is because I bought it during some old episode when I made money trading Lyft. I used the money to buy a share. And that was $28, so I think it was probably like here or somewhere. For a while, it wasn't bad. That was a good price to get in at, $28, but it's just tanking. Like, whoever actually bought this thing at IPO is down, what is that? 80% or 70%, 60%, something like that. A lot of me, I think, I don't need a lot of these positions anymore. Like, it was fun at the time when I was doing the 3K challenge to trade what the crowd wanted, make some money on it, or lose money, but make money on it, and then buy whatever position I was trading at the time. But I don't really want a share of Lyft or, I guess Jets. I don't know if I want American Airlines, though, or Lionsgate Studios. Like, a lot of me wants to liquidate some of this, get some liquidity back, so I can do more frequent trading. Instead of, right now I've got, $288 left in cash? The rest of it is all tied up. Nuva, do I need a share of Nuva in this account? So I do want to revive the 3K challenge because I did have fun with it, and it's some of the more enjoyable stuff to make. But I got to switch up the way I'm doing it a little bit. And everybody picked these really weird stocks most of the time anyway. I don't know if that's really what I want to do. Now, what I have heard, though, is that Lyft drivers right now, so Alpaca Stuffs, he says, I don't know, wait, that's not it. One of you guys said that you are a Lyft driver. Yeah, Alpaca Stuff says he's a Lyft driver, so he's bearish on Lyft. So did Lyft start paying people more money or something like that? Is that why Lyft is financially struggling right now? They can't sustain themselves without underpaying drivers or something like that? I'm looking through some of the comments here. Everybody's bearish on Lyft. Yeah, who bought So my old boss actually bought Rivian. And he's he was a Wall Street guy. Definitely a millionaire, no doubt about that. He bought Rivian, up here. It wasn't quite at the highest point, but it was up there. And according to him anyway, if they can, once the supply chain issues resolve, Rivian will be one of the premier auto producers. I can't vouch for the accuracy of that statement, but he seems to believe it. He bought some for his kids. And my neighbor who writes for the Motley Fool said the same thing. He's like, Rivian is the truth. They can't produce. They don't have the supply. I wonder how true that is. It's obviously not something I would buy now, because if this thing is going to be the next Tesla, it's got a long way to go, and you got a lot of time to get into it. This is not where I'd want to be. No, Frost, the American Airlines leaps is long gone. So I PMCC'd it for a while, and I can't remember if the stock went up or down too much, but one of those directions, it had gone too far, so PMCC was no longer viable. I know I did profit on the trade overall, but I didn't profit nearly as much as I could have if I just went with holding shares instead of the PMCC. But that's part of the risk of it. You don't have to put as much money in. But these airline stocks, they're not doing so hot. I mean, I've got 8 shares of American Airlines, and I've got 2 shares of Jets. I think given, the choice between the two, I would take Jets. This is an ETF that holds a whole bunch of the U.S. and the Canadian industry. U.S. and non-U.S. airline companies, concentrated portfolio weighted toward domestic passenger airlines. So it's mostly the U.S., but it's got some Canadians in there too. That's probably what I would choose if I had to choose an airline, like gun to my head. But with fuel prices rising, that means that ticket prices are rising. That means margins get thinner because the airlines got to compete with each other. What else we got here going on? All right. So Jackie J says, all right, Lyft, Uber, and DoorDash are all struggling with profitability after COVID, probably because fewer people are buying food. I mean, I don't think they really made that much money on their whole people delivery business. It's all the food delivery. Now that people aren't doing that as much anymore, it's going back down. All right, Bruno, about Coin. So here's the thing about Coin. Like, I still believe it's a good company and it's going to emerge stronger. But they have failed to deliver on the promises that they have made. We had Brian Armstrong talking about how, that's the CEO, talking about how Coinbase is going to continue innovating. They're going to drive new people to use Coinbase. So I'm thinking, all right, they're going to really pull out some cool stuff here. They're going to work with regulators and get us some interest-bearing accounts. They're going to demonstrate that they can be successful financially, whether markets go up or down. Crypto markets, that is. And what did we get instead? We got a Super Bowl ad of a QR code bouncing around the screen. That was their innovation. This company has not evolved since 2017. Meanwhile, we've got new cryptocurrency exchanges that are entering the market that are much more competitive than Coinbase. FTX comes to mind immediately. So what is it that Coinbase is really doing to make itself a premier exchange? All they're doing is being the easiest to get on board with. They make it easy to sign up. They make it easy to transfer your paycheck into crypto. That's it. But there's other competitors that are stepping in the market to do that. So until Coinbase really starts shaping up and delivering on some of its promises about innovation, I mean, how am I supposed to want to hold this stock? So I sold it. I sold it for a big loss. It was actually about this price again. For a little while, I felt smart. It was a couple of weeks ago. It was about 130. I'm not exactly sure where, but it was about this price. And when it dropped down into the low 110s, I felt smart. Now it's starting to come back a little bit. But I'm looking at, this is one of the bigger holdings that I'm moving a lot of my money into right now is JEPI. So it's a income, it's dividend focused. Let's see if it even shows it down here. I thought they used to show that type of information. No, it's a chart. It's about 7.5% dividend. So the reason I'm getting into that now is because if I take a lot of this money that I have sitting in growth, that's just getting wiped out, and move it into income, I'll have enough money that I don't have to worry about income anymore. Like one of my goals is to be able to make money while I sleep. And you can do that with data gang strategies, but we see how quickly that can turn around. The market goes up or down 8% in a week. That's it. You can lose all the gains that you've had for 2 previous months. But with income stocks, if you have the money for it, dividends can be a pretty powerful tool. So I've got, I think 54,000 in JEPI right now, and then just under 100,000 in QQX. So these two together are bringing me, I think like 18,000 a year in dividends. I want to get it to 24, and then I will start rotating more back into growth. All right, that was a long answer about Coinbase, but let's see. Somebody wants to look at PCG. I do admit I don't know much about PCG. This is like the California company. Like they're focused on California or based there, and they just win contracts year after year. I mean, I don't know why anybody would really be long on this right now. I think they were going bankrupt at some point in very early 2020, or they were like unable to pay their debts or something like that. If this is the company I'm thinking of, California, yeah, that might be it. What else we got in there? Ben M, I'm right there with you, buying coin at IPO. I even live streamed myself buying, what was it, like $38,000 worth of Coinbase. Yeah, that was That's probably one of the most embarrassing trades I've ever made in my entire life. And I was on there talking about it too. I was like, hey, this company is going to is going to change the game about cryptocurrency. They're going to bring more people into it. This is what we need to be investing in. I was prepared to put up more money into Coinbase. But after I saw it dropping like that, I said, it's too much risk. So I held 100 shares until, I don't know, what was my loss? I sold covered calls along the way. So probably somewhere between $14,000 and $15,000 just gone, wiped out. What else we got? Adam J has got Jeppy, NewC, Triple QX, GOF, and QILG. I've wanted to look at GOF before because people have talked about this. Guggenheim Strategic Opportunities. So is this the one that sells covered calls on like a... Oh, wow, they really shot up here. That sells covered calls at like at opportune moments or something like that. Pursues a relative value-based investment philosophy. Utilizes quantitative and qualitative risk, blah, 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 blah. So they trade stock... So they buy low and sell high, basically. Yeah. That's good. I mean, that works for me. 11% dividend. Yeah, I'll take it. Yeah, this was one of the ones that I meant to look at, too. I don't know about... I don't know if NewC is really what I want to get into, because I think they sell or they buy their puts a little bit too far out of the money that it doesn't really protect them from those steep drops. And QILG, I think QQQX already kind of does the job. But GOF is one of the ones I wanted to look at. And my daughter's word for coloring or coloring book or crayons, all that is GOF. So I can personally connect with the stock GOF. So Johnny's Seltzer Reviews is asking, do I stake any crypto, stablecoins, Polkadot, etc.? So I do. I use FTX. It's actually Blockfolio. I wonder what it's going to get me to. If it's going to send me to Blockfolio. So on the app, it used to be Blockfolio and now it's FTX. So it's mobile only. You can't check it out on desktop. But you get 8% on your crypto and fiat. So it's not supposed to be for Americans to use because that's a security now. But they automatically invest it for you regardless of whether or not you indicate that you're an American or not. So I think right now they're pretty much the only one standing that's easy to access and get interest on. But I'm stacking crypto in here in Blockfolio. It's mostly Bitcoin and Litecoin. And then they give you like Dogecoin every time you deposit or every time you transfer crypto. They give you like one SHIB or one Doge. You know, if you get lucky, you might get one BAT. But it's this interest here that I want to. So up to $10,000, you get 8%. So if you have $10,000 in there, you'll get $800 a month or $800 a year rather. That's where I keep most of it. What else we got here in the comments? So Nicholas Richards is talking about Ledger X. So on Ledger X, I have a video on this. I don't think it's even going to let me get in. Maybe I could just look at the options chain here. All right, so on Ledger X, you get an options chain and you can sell covered calls on your cryptocurrency, just Bitcoin and Ether. But I've got 2 Ether in here that I sell covered. I wheel it. I just wheel Ethereum on Ledger X. At one point, for an at-the-money covered call, at-the-money expiring in 2 weeks, at one point that was hundreds of dollars, like $600 for a month-long position, $300 for 2 weeks, or $300, $400 for 2 weeks. Now the premiums on this thing are so low because cryptocurrency hasn't had a real run-up yet. But hey, once premiums start going up again, when cryptocurrency comes out of its winter, starts rising again, you're going to start seeing those really high premiums. I remember at Bitcoin at one point, when it was rising, it went from, I think, 40,000 to 60,000 in the course of 30 days. The premiums on the $100,000 covered call expiring in 6 months was like $5,000. So that was enough to buy a tenth of a Bitcoin by agreeing to sell your Bitcoin. What would that be? Like 70% out of the money? Just like that? I mean, that's a bullish skew on cryptocurrency prices. So if we can get back to that point again, I will gladly start transferring more money back over to Ledger X and start selling covered calls again. That's just big money. And then I would use the premium I got for selling those covered calls to buy more crypto that I would not sell covered calls on, just hold it in cash or just hold it in the coin. Ayatha Doses recommend I look at yield farming if I'm staking. So I do want to yield farm, I just don't know how. And all the online guides suck. I'll tell you, if knows how to effectively yield farm, make a video on that. Make a channel on effective yield farming, and you will absolutely get subscribers. You will make money. You can tell people about airdrops that are actually good. Like if you put some work into it and find good stuff, people will gladly follow and subscribe to your channel. I will absolutely use your resources during the freeloader challenge. You will get referrals for doing it. You will make money. But all the yield farming stuff I see on YouTube is either absolute junk, or it's a scam, or it's not user friendly enough, or the person trying to explain it to you is just pitiful at it. There's so many problems with that. But I would love to have a reliable, honest yield farm channel I could follow and an airdrop channel I could follow. Those would be phenomenal. Let's see if there's any comments on that type of thing. So Dylan says 90% of crypto yield farming is a scam. Yeah, I can see that. Because people they want to throw their money into something that's going to give them high yield. And they're not doing enough DD on it because they feel like they got to be quick before it drops back down, the yield price. Or yield APY. I'm not familiar with alpaca coin yield farming. I'm going to have to look at that. Hey, Dylan, if you know how to yield farm effectively, like do it and tell other people how to do it, and you'll make money on it. You know how many sponsors would love to get somebody that's actually like, I type in alpaca farm and it gives me actual alpaca farms. Alpaca finance, is this what you're referring to here? Alpaca animal collection. You know, given the choice, I might look at actual alpaca farms. That might be a better ROI than investing in most of these cryptos. I mean, look at that alpaca. It's a cool guy. Hey, so Daryl, I think I actually do have an answer for you about your freeloading from outside the US. I'm going to do a dedicated video on it for, it's going to involve Zengo and how you can get money that you can then transfer over to Zengo for interest. So I may do that. Right now, I'd recommend getting on free cash and looking for the Zengo offer. That's ZNGO, and that'll help you get started with it. Alpaca finance. All right, so alpaca stuff. I give you permission to drop that link to your channel in the comments here, and maybe we could do something there. Because I do want to yield farm. I just don't know how. You know, if I look at free cash right now, let's see what's on it. So there's this. This isn't going to count toward my freeloader challenge, but for anybody that has the ability, they feel like to refer some friends, you can get, you know, $50, you know, with a handful of friends referring them to it. It's worthwhile. I mean, that's not going to count toward my freeloader challenge. And those that are on free cash, you should use this rewards feature. I don't have it right now because I already did it today, but you can get 10 cents a day for doing nothing. All you got to do is log in. So you just, you know, grab your 10 cents and you're done. Or you can do double or nothing until you run out. But that's it. I mean, what I would look at right now, people need to be downloading. I want to see if Zengo is still on here because this is a really, really good one. Zengo was like $68, I think. I have it now. I hope it's still on here and people can reach it. Yeah, I'm not seeing it now. If you're in New Jersey or any of the states with the large gambling thing, I was in New Jersey for Easter and I was able to get like $158 for BetMGM online casino. And then while betting $20, I won $18. I just thought it was going to be a write-off. But I was able to make $18 plus I got the $158 from signing up to BetMGM. So it was like $170 right there. Now if you throw that into a nice stable coin and stake it, you'll get 8% a year. It's not going to be a ton, but it'll get you somewhere. I don't see Zengo on here right now, but I mean, poke around the website for it. That's a really good place to stash some cash. What else we got going on in the comments? You guys are actually talking about alpacas. That's pretty cool. Do I still hold Lamb? Yeah, I do have LRCX. What are they doing right now? Okay, yeah, that's fine. All right, see you soon. Wow, all right, LRCX shot up. See, I sold a lot of this for Jeppy. I have 68 shares now. So it's obviously looking pretty good. But I sold it pretty darn close to the bottom of this dip. Definitely at a profit. But I wanted more cash so I could put it into Jeppy. I said, there's no way I'm going to sell the rest of my LRCX. The price is still too low, I think, at this price. But I wanted to get more Jeppy. I think once I have $100,000 each into Jeppy, Triple QX, and then probably either GOF or SPYD, then I'll be at the point where I say I feel satisfied. SPY. Am I looking at the right one? This isn't what I wanted. SPYD. Yeah, dividend ETF. I'm disappointed that Robinhood doesn't show the dividend on this. Does it? I thought it would. But it's not right now. I think it's something like 7%. ZENGO. Ultra Richard. I'm sorry, not ZNGO. ZENGO. Find this one. This is a really good. Matter of fact, why don't I just give you the... I'll just give you my referral to it. Actually, no. Don't take my referral to it because you got to find it on... you got to find it on free cash so you can get the money for it. If you use my referral, you won't get any money. But, all right, make a freeloader guide for teens, please. I need help. So, nice raindrop. I am making one of those right now. Somebody sent me a script to do for them. They're paying me to do it, but it's good stuff. I wouldn't make it if it wasn't. It's associated with free cash. So, Bruno Hager always says, why SPYD, not SPHD? Wouldn't the monthly dividend be better for the income? Yeah, I don't think I'm going to be needing the dividend monthly. I think I'll be able to budget without too much trouble. And I think SPYD does kind of beat out SPHD in the long term. I do have about $11,000 in SPHD, so I am getting the dividend for it on a monthly basis. I think if you're really choosing between very, very similar ones like that, then you're going to end up splitting hairs a lot of the time, which I don't want to stress over, fractions of a percent on an expense ratio. I want to be able to get my money pumped into these things. So whether it's SPHD or SPYD, I don't think it's going to make a huge difference. I have to look at Goff a little bit more because I've been meaning to look into this one. I think Goff is definitely a contender. VM says you can do stablecoin staking on Curve, but you really need to stake some CRV and delegate the VCRV to get that to CVX to get the real gains. I see VM. That's the type of thing I'm talking about. Like, I don't know how to do that. I don't know what it means. How do I stake stablecoin on Curve? Like, do I go to curvecoin.cv or something? I mean, there's an entire curve.fi. Like, there's an entire demographic of people that would love it. I mean, this looks like it was from 2001. But there's people out there that would love to get into something like this. I just need a guide that can show me how to do it so I can get some decent yield on it. Yeah, I mean, this looks a little bit sketchy to me, I'm not gonna lie to you. But having some way of knowing what I'm doing here, some guide to show me my way, that would be extremely helpful. And right now, there's just not a lot of information like this on the internet. Not reliable ones, anyway. Now, let's see what the market's doing right now. So we're still mooning, obviously. Man, just look at it go. That's a big swing. It's $14. More than $14 on Invesco's Triple Q. Do I have a share of SPY in this thing? I don't think I do. Yeah, I sold covered calls on QQQ or TQQQ right like here. I sold the 36. It was at 36. So it was probably it's like right here. And for a minute there, it was looking great. And it almost went down that far today too. If you look at the daily chart, when it was down here in the 36s, I was like, I could probably close and get some decent money out of it. Didn't even look to check and see. And now it looks like I'm going to get assigned. Let's see what would happen if I rolled. Let's see if I buy my 36 for 605 and then sell next week's. What could I roll to? 36. It's not worth it. I'd have to roll a month out. Yeah, I'm not doing that. Yeah, I'm going to do that. So I'm going to take assignment on 9 lots of TQQQ. That's going to give me $2,100 in income. And then I'm going to sell puts the following week back at 36. So $68 times 9. It's not nearly as much. It's only going to be like $540. Maybe I'll bump it up a little bit and sell at my basis. It'll be about 39. Might give me about $1,400. That sounds a little bit better. $1,300. Yeah, that's what my plan is right now. Okay. So that's good. I mean, wheeling TQQQ can bring you income, but on days like this, you get blown out. And then you start feeling dumb seeing what happened to it. All right, I'll be right back, guys. All right, my wife's food shopping is complete, and now she's going to the gym, her very expensive CrossFit gym, but that's okay. She loves it, so if I can spend hours and hours at a time streaming, it's okay if she wants to go to the gym. All right, let's see. Okay. Hey, what I gotta do... Hey, so I'm gonna play... This is my brother's first YouTube video. I'm gonna play for you guys, because while this is playing, I got something I gotta do over on the side. And I need 2 minutes, so enjoy.
Let's get that bag, boys. Ogre smash. I see dead people. Witness murder.
All right, that is his channel. So yeah, really exciting stuff going on over there. That was a ton of fun to make. All right, look at that. I'm back over $4,000 on this thing. Even though I've lost 23, no, 34, 38, 22, 29 on this spread. See, Sean, what you're describing there about avoiding the actual yield tokens. Look for single stakes and auto compounding. No, your investment can disappear at any moment. That last sentence is concerning. You know, if I'm going to be freeloading, I need to know that my investment's protected. If that was the bottom in the market, I'm actually going to be a little bit disappointed. Because I am flat-footed. Very flat-footed coming into that. Not adequately leveraged for my personal risk tolerance, if that was the bottom. At least Jeppy's up. It's pretty good. So, all right, I guess we're going to wrap it up here. Thank you, everybody, for getting in on it and joining. Appreciate it. And congratulations to everybody except Lyft holders. Anybody who holds Lyft right now, rest in peace. Literally everybody else, congratulations. Especially congratulations to those who bought calls 0 data expiration. It's awesome trading. So I will see you guys next time. Actually, matter of fact, before I end it, join Discord. It's in the link to this video. It's free. Come, hang out, enjoy. I'll see you guys later.